Last year was a brutal one for stock portfolios, retirement accounts, and some local businesses. I'm Andrew Thien, and this is Beat Check with the Oregonian. We've got business and technology reporter Mike Rogoway on the horn today to talk about last year, this year, and what to make of the economic climate in Oregon and beyond. Welcome back, Mike.
Yeah, it's good to be here, Andrew.
Happy New Year.
Happy New Year to you.
So you took a look at last year and kind of what it meant for some Oregon businesses. What did you find?
Well, of the publicly traded companies in Oregon and Southwest Washington, it was a bad year, probably verging on atrocious. Now, companies across the country had a bad year. The S&P 500, which is the broad market index we often look at to see how Wall Street is faring, it was down 19%. It was a tough year, which wasn't shocking given there were two strong years in 2020 and 2021, and then the Fed's raising interest rates to curb inflation. And of course, that brings stocks down. But it was particularly bad. Among the region's most prominent and most valuable companies, there's about 24 on our list. Only two finished ahead for the year, and 2/3 underperformed the S&P 500 and some way underperformed it. And it's to a degree, stock price is a measure of companies' performance, but it's also a measure of the company's future prospects. It reflects what investors think, and it has a very real effect in that if companies want to raise more money, a depressed stock price makes that harder and sometimes impossible.
Okay. So it's not just the long-term outlook, it's the short-term outlook as well.
Yeah, it's where things are at now. It's where people see things going down the road. It's both a scorecard and a real sense of how the business performs and what its options are going forward.
Okay. Well, you recently took a deeper dive into kind of the how and why some of the startup companies or companies that, got all gussied up to join the stock market, put on their finest suits and, had their symbols on the ticker. And it was pretty disastrous for some of those companies. Who fared the worst?
The worst were maybe 5 companies stand out. Arcimoto, Laird Superfood, Vicasa, Expensify, and ESS Tech. And they were all down more than 75%. And one thing that stands out about all of them is they all went public in the past few years. Oregon really didn't have any large public stock debuts from 2004 or so until just the last couple of years. And we had several come out, and one or two fared pretty well, like Dutch Bros has held up pretty well after its strong debut in 2021. But a lot of the smaller companies have not. I might go through a few of them if that's all right.
Yeah, exactly. Arcimoto is the one that let's start with them, because this is kind of the quirky electric vehicle company with the owner, founder with a famous name in Oregon history, but it's been a rough ride. Yeah.
So Arcimoto makes these, as you say, quirky electric vehicles. They call them fun utility vehicles or FUVs. They're 3-wheel electric motorcycles. They've got a roof on them, and they're sort of semi-enclosed, about $20,000 a piece. And when they went public, there was enormous enthusiasm for electric vehicles, and they became kind of a meme stock. People were talking them up online and message board threads, and the company, they're based down in Eugene, was worth more than $1 billion in 2021. Well, it's lost almost all that value. It's now worth about $10 million. It was down about 98% last year in terms of its stock price. And there's a few things that went wrong for them. They went public before they built out their market or their big factory in Eugene. Our colleague Jamie Goldberg wrote about them in 2021, some of the issues with going public when you're a young company. And it hasn't really paid off for them. There are also some fundamental operational and market problems. They haven't proven that there's a mass market for these vehicles. And when they were valued around $1 billion, I think they were pitching the idea that this was an alternative kind of transportation. It might be that for everyone, but it might be that it's a three-wheel electric motorcycle is more of a niche. That maybe it's something people would rent when they're on vacation in a sunny place to do a self-guided tour. Or maybe it would be good for getting around university campuses or something like that. But maybe it's not what people will drive. Most people will drive on the street. You do see them around town. There are some, but they don't sell a lot. They're selling dozens a quarter, not thousands or tens of thousands. Mm-hmm. But then you'd mentioned the famous Oregon name. Their founder and CEO was Mark Frohnmeyer, who is the son of Dave Frohnmeyer, former Attorney General and University of Oregon president. Well, in August, Arcimoto suddenly replaced him, even though he's their largest shareholder and their founder. And they didn't explain why. But it didn't take us very long to figure out that he'd just been arrested for driving one of these FUVs while drunk. And he acknowledged then when we asked him about it, that, yeah, that's why they kicked him out. Yeah. Layoffs and furloughs followed, and the company continues to turn out vehicles, but its future prospects are unclear. Last fall, it said it was exploring strategic alternatives, which is what companies say. It's the euphemism they use when they're looking for somebody to buy the business. At a market value of $10 million, it wouldn't cost somebody a lot to buy it at this point. But the fact that they don't have a buyer yet suggests that they may be in a fairly difficult position.
Okay, so that's kind of this interesting company with, various things going on both at the top as well as just market-wise what its use is. What other companies did pretty poorly last year? You mentioned a few of them, but any other ones that you want to talk about?
Yeah, well, we talked about Laird Superfood, which is a company most Oregonians might not know, but some people may know their founder, Laird Hamilton, a popular surfing personality. It's a plant-based food company and Sisters. And, it went public in 2020 and like other meme stocks, it developed a enthusiasm among investors. The stock climbed as high as $60, but it didn't get that same enthusiasm among customers. Its sales are growing, but not fast enough to overcome its losses. Its losses are growing even faster. The stock that was above 60, as we said, is now at 88
That's not good.
cents. And so its prospects are bad, and it's obviously been a terrible investment for people who invested in it. One of the more intriguing companies to fare poorly was Vacasa, which was down 85% last year. If you rented a vacation home in Sun River or on the coast or up by Mount Hood recently, you might have gone through Vacasa. Portland-based company that both manages and markets vacation homes. Mm-hmm. And they have a rapidly growing business. They do more than $1 billion a year in sales. It's in some ways the first big new company to emerge in Oregon in many, many years. But when they went public late in 2021, they used a novel approach that had kind of become a popular fad in 2020 and 2021. They went with a SPAC deal. It's merging with a publicly traded investment fund and took over that investment fund stock listing. It became a popular way to go public without all the rigmarole and expense that usually comes with going public, but also means less investor scrutiny. And sometimes that investor scrutiny is useful. Vacasa replaced its CEO last year. The new CEO came in and said in November that the company has pretty severe operational problems. It's got cost overruns and poorly executed marketing plans. So even though sales are still growing, they're not growing nearly as fast as they were. And the bottom line, the profitability situation is not what investors had been expecting. So their stock is down, around $1, and having lost 85% of its value last year. Their new CEO says it may take considerable time for that company to get back on track, which is worrying for the first big new company to emerge in Oregon. If there's an upside, it's a real business that they have, and if they can get their operational issues in place, then there may be opportunities for them. They're not just a meme stock; they're a real business, but it will take some some time, evidently, to get things going.
Yeah. So what are the consequences of these poorly performing stocks, for the employees, I guess? Obviously, profitability is a big driver for these companies. They need to, they're not nonprofits. They want to make money, but what's that mean for the workforce?
Well, oftentimes you'll have young companies compensating their employees in stock. So the value of your compensation, particularly with young companies, that's the way they do it. The value of your compensation has declined considerably. You may have thought you were making a lot of money at a new company, but suddenly a big part of your compensation is worth less or maybe worthless. So that's very worrying. And then there's the real existential issue of whether these businesses continue. Arcimoto, of course, laid off and furloughed a bunch of people last year. Vacasa had a smaller number of layoffs too. So it's a matter of whether or not you keep your jobs. And ideally what you'd have with young companies is a lot of growth opportunity. And that's not what they're delivering right now.
Are there any common threads between these companies and in terms of why they're struggling, or is it just kind of all
I
of the
think
above?
that the newly public aspect of it is really a big one. I think, with Robinhood and meme stocks and day traders, people sometimes maybe saw more runway. These companies themselves saw it than really existed. It was kind of a mirage. But if we look at some of the bigger companies, even really well established businesses last year, like Nike was down almost 30%. Dutch Bros, which had a great 2021, was down 44% or 45%. What you're seeing there are kind of the effects of the broader economy. Take Nike, the largest company based in Oregon. They struggled. Well, their stock struggled because they had supply chain issues with closures in China. Well, the same kind of supply chain issues every industry is facing. And then investors are concerned about 2023, what the macro economy looks like, whether there's going to be consumer demand for shoes, for what amount to luxury products that sometimes cost hundreds of dollars going forward. The good news for Nike is that they issued a strong quarterly report in December and a good outlook for the rest of the year. Their fiscal year is different from the calendar year, and investors were really enthused about that. So that paired a lot of their stock losses from 2022. They took a nice jump at the end of the year. Dutch Bros, is a newly public company that has held up pretty well. There was a lot of concern early in 2022 about the effects of inflation on their business. Dairy is an important component of their business, and dairy prices have been high and sustained high. Their labor costs were rising.
Gas prices.
And some of gas prices were pinching consumers. And was there going to be as much demand for, really expensive energy drinks at their drive-through kiosks? Those concerns alleviated somewhat toward the end of the year. They appear to have their business together, but it's not going to be in the short term maybe quite as profitable as people hoped, even though Dutch Bros is maintaining the growth trajectory that they had outlined before. They're expanding in California, and particularly places like Texas, Oklahoma, Tennessee, South and Southeast that seem to be natural markets for their suburban and sort of exurban, perhaps, or quasi-rural markets.
Okay. Well, that'll be something to track. Maybe that's a good pivot point for, we're now firmly in 2023 at this point. What's the outlook look like here in Oregon and beyond? Or what are the business fundamentals you're tracking this year?
Well, our colleague Elliot Noose, our business editor, had a story over the holiday break when new census numbers came out, showed Oregon's population growth was actually negative last year. And that followed a decade of really strong growth, and particularly drawing, state economists were really excited in the years after the Great Recession because Oregon was drawing highly educated, relatively young migrants from other parts of the country and sometimes from other parts of the world. Those are very important to the economy. They add skills. They draw employers as well as employees. and they add to the state's tax base.
Right.
Well, if something has happened that now our population growth is negative, that's really concerning. We've had an issue like other states with an aging population. In the pandemic year, for the first time in 2020, deaths outnumbered births in Oregon. So we're not having what the economists call natural population growth anymore. When we have a growing population, it's because people are moving from elsewhere. And economists like to see a growing population because it creates economic opportunity, more consumers and more producers. So if the population is shrinking, if Oregon is no longer a draw from other states, then that's concerning. I think the economists aren't really sure yet what to make of those census numbers. Portland State has its own population estimates, which show modest, very modest, but population growth during 2022. So that's more encouraging. And it could be the pandemic either warped migration patterns or maybe warped census collection data. So the picture may not be quite as bad as it looks, but that's a big open question going forward.
Yeah.
And, we've got to work it out. Oregon has some real issues, a housing affordability crisis. It's still a nice place to live, but if it's too expensive, then we won't be a draw.
Yeah, the pandemic warped a lot of things and warped some of our brains, and
Yes.
Obviously changed how we view downtown and in a lot of ways.
And that's an important economic indicator for next year as well. As everyone in the region knows, the city has some severe livability problems. We mentioned housing prices. A related issue is homelessness. And there's also crime, vandalism, trash. The murder rate has remained elevated throughout 2022.
Yeah.
It's clear that the city now has identified those problems as something it needs to address. And, the mayor and the city council have outlined plans to do them, to address those issues. The question is whether the city will be effective in addressing them. To this point, clearly, in terms of violence, the city has not been effective. The murder rate remained high in 2022 after the big spike late in 2020 and 2021.
Yeah.
So that's a big question. And we've talked a lot about downtown. Every indicator we've seen has shown only modest recovery. Now, I'll add a caveat to that. Something I've been thinking about recently, Andrew, is we compare us to other cities with kind of depressed downtowns, and our recovery has been slower than elsewhere. But I will say downtown isn't deserted like it is in the New York Times, for example, had a recent article about San Francisco's deserted financial district. Portland's downtown is more integrated with the lives of the community than in other cities. We have the big theaters are downtown, the big sports venues are either downtown or right adjacent to downtown. We have a waterfront that's still a popular destination, and we have a big university that's downtown. So even though office work is way downtown, it's not like a ghost town down here at all. I'm downtown today, and I am most days. It's not like it's empty, but it hasn't picked up from the pandemic the way other cities have, which is definitely very concerning. So I don't mean to say, that downtown isn't facing major issues. It obviously is. I just want to put it in some context.
No, I appreciate that. And I guess time will tell. The city of Portland is requiring its workers to spend a certain amount of days in person in the office. And that starts in the spring, I believe. So it'll be interesting to see how that plays out and whether other private employers follow suit.
Yeah, that's been a real tug of war. We had a syndicated column from Bloomberg in our paper about that issue. With the labor shortage being tight, with the labor shortage continuing, labor market being tight, employees still have a lot of leverage. And if they don't want to come into work, employers are hard pressed to say, well, we'll fire you if you don't. Well, okay, but who are you going to replace us with? And workers have plenty of other options, many of whom are flexible. I think that's where we're settling out is a degree of flexibility, a degree of hybrid work is what's coming. And it may mean that downtown is never quite what it was in terms of office work. There may be ways to address that, make other things attractive downtown.
Well, before I let you go, obviously the legislature will be convening here down in Salem, not too far from now, not too long from now. We've got a new governor, you've got a new legislature in terms of the makeup in the chambers, new members, new leaders. What are you tracking on that front in terms of business-related issues?
Well, as you know, Andrew, my main focus is technology reporting, and we have a really interesting sort of tug of war there. The legislature will be looking with a session that begins this month at creating more incentives and direct funding for the semiconductor industry. They're trying to capitalize on the $52 billion in federal CHIPS Act money that Congress approved last summer. Mm-hmm. That's going to be, the Commerce Department is going to start doling out that money, perhaps as soon as February, but certainly by spring. And Oregon badly wants a share of that. Semiconductors are one of Oregon's major industries and about half of our exports. And so the state badly wants in on that. To do that, the goal will be to create tax incentives for R&D, to create incentives for creating and allocating industrial land, workforce development, and streamlining environmental permitting. There'll be a lot of tension around some of those issues. And at the same time, it'll be considering that the legislature is facing a renewal of one of the state's major tax break programs, the Enterprise Zone program, which is primarily used by data centers for big tax breaks in rural Oregon. Oregon's unusual in that it allows small communities or any community to give unlimited tax breaks. And as a result, Amazon, Google, Apple, and Facebook get the lion's share of this program, tens of millions of dollars a year cumulatively. And the legislature is looking at whether the size of those tax breaks is whether those data centers would be here without tax breaks of that scale. And so on what I'm saying is on the semiconductor side, the state is looking at bigger incentives. Mm-hmm. On the data center side, the state is looking at perhaps smaller incentives. So it'll be very interesting to track how that evolves during this session.
Yes, it will. And we will make sure that people know how to find your stuff. And thanks as always for coming on the show. Thank you for listening to Beat Check with the Oregonian. Like I said, I'll share links to Mike's stories on stock performances, data centers and enterprise zones, Intel, all of his work. You can find it at OregonLive.com/business. If you like this show, please give us a 5-star rating and review in Apple Podcasts. That's how people find it. And tell a friend. Word of mouth is the best way to talk about podcasts. We've been doing this since 2019, and we'd love to keep growing it in 2023. The best way to support our journalism and work like Mike's is with a subscription to Oregon Live. You can do that at OregonLive.com/pod supports. Until next time.